Patriot Nation, I know what you're thinking. You've got you and your family in a pretty good spot financially. You own your home, but now it's time to take the next step. You're thinking about buying an investment property for the first time, and that's a great choice. In this video, we're going to talk about the 3 best loan options to acquire investment properties. So if that's of interest to you, let's kick off this rodeo right now. So I'm Kevin Fagan. I'm the Mortgage Patriot, on your side, nestled here in the Hill Country above San Antonio, Texas, and serving all you proud Texans and all you great folks all around the country. So as usual, a very important topic here because we're going to talk about investment properties. As you may or may not know, 20 to 25, almost 30% of the existing sales now in the United States are to investors. And it's not just big companies, it's individuals that understand the benefits of owning rental real estate, investment properties. But today we're going to talk about the 3 best choices to acquire real estate with financing options. We're going to talk about conventional loans, we're going to talk about DSCR loans, and then we're going to talk about home equity lines of credit. Some people call them HELOCs. We'll explore all those different options, tell you what the benefits and what the advantages are versus disadvantages on each one, because they all have their separate advantages and disadvantages. And we're going to wrap it all up at the end with an example, and you're going to walk away feeling like you understand quite a bit, and hopefully I can help you secure those properties. So let's get into that content right away. If you would, please hit the like and subscribe below and maybe even add a comment. It really helps with the YouTube algorithm, of course, as you know, and brings my content up to the forefront. And you'll see some examples here, investment strategies that I've done videos on before. FHA, how to acquire investment properties using an FHA loan, investment property purchase using a VA loan. Now, spoiler alert, those require living in the home first. Those are primary home loans. So you have to move into those homes first and then typically move out after a year or so. So that strategy is specific to those videos. We're going to cover a pure investment strategy now where you already own your home, you're intent on staying in that home, but now you're going to be buying an investment property and renting it out to obviously other tenants. So as I mentioned, there's really 3 best loan options to acquire investment properties. And that is conventional loan, DSCR loans, and HELOCs. So we're going to talk about conventional loans first because that's typically the lowest interest rate among the 3 choices. So you want to try to start there, and if you can qualify, great. In terms of credit scores, it's going to be pretty much the same across the board on all 3 choices, but obviously the higher the credit score, the better your pricing will be. But typically, investment properties start off with at least 660 to 680. 660 to 680 on your credit scores. As you go higher, your pricing gets better. Secondly, let's talk about income documentation. Relative to the other types of loans, with a conventional loan, you need 2 years. 2 years of income documentation, meaning you need to show W-2 returns or tax returns, personal tax returns for the last 2 years. If you cannot show that, then we have to go through the other options. But again, you want to try to do this because you want to get the lowest rate. So 2 years of income documentation is required on the conventional loans. And lastly, in terms of down payment, another reason why you'd like the conventional loans is because it's got a lower down payment than the others. In the case of conventional loans, it's about 15% to 20%. In other words, you have to put 20% down. They're going to give you an 80% loan, but there are some that will go as high as 85% loan to value. So in other words, you have to come up with 15%. So in the example of you're trying to buy, say, a $250,000 rental home, you're going to have to come up with a down payment of about $37,500 plus closing costs. So keep that in mind. So your out of pocket, depending on what you negotiate in terms of seller concessions, could be anywhere from, say, $40,000 to almost $50,000. So that's a pretty good chunk of change. But obviously, as you know, the benefits of owning rental property, appreciation, tax benefits, and so on, it makes it worth your time. So let's talk now about option number 2, DSCR, and we'll compare that to the conventional. So let's talk about DSCR loans. What does that even mean, DSCR? That stands for Debt Service Coverage Ratio. Okay, what does that mean? That just means what is the rent relative to all your costs that are associated with owning that home. So let's take an example. If your rent, for example, you buy that $250,000 home in our previous example, your rent from that is $2,200. What are all your costs? Well, you have principal, you have interest, you have property taxes, you have property insurance, you have HOA dues. That pretty much covers all the costs. Let's say your costs are $2,000. So you're taking in as rent $2,200, your cost of $2,000. That ratio is 1.1, meaning rent to debt service coverage. Any ratio that's 1 or better is considered good. And most lenders that offer DSCR loans will allow you to go forward on the basis of a 1 ratio or better in terms of rent versus the cost. Now, what are the benefits of the DSCR loan? We'll start with the credit scores. Credit scores, again, are about the same as on the conventional side, about 660, 680. But again, the higher you go, the better, but more acceptable it is. In terms of what your income qualifying documents are, in terms of the conventional loan where you had to supply 2 years of history, the DSCR just waives all that. All they care about is the rent coming off of that property. So we mentioned $2,200 versus the cost of $2,000. That's all they care about. So you can literally buy a home using a DSCR loan as long as the rent covers that debt service. And of course, you can come up with a down payment, which we'll talk about next. But that's the beauty of the DSCR loan. So sometimes if you're a self-employed individual and you don't maybe show enough income on your taxes, lots of self-employed people, they're maximizing their benefits from a tax standpoint, which is all absolutely valid. But when it comes now to time to try to buy something, hey, well, my taxes only show 50,000, but I really make about 100. Well, lenders don't care about that, right? They're only looking at what your taxes are. So the DSCR loan circumcedes all that. And you can purchase a home using the DSCR. Let's talk about the down payment. Down payment on the DSCR is a little higher. There are some that are 15%, but it's rare. But mainly are 20% down or 25% down. So you do require a larger down payment on a DSCR loan. But again, the great advantage is you don't have to show taxes. You don't have to show income. You only have to prove rent versus your actual cost. So that last type of loan that you could consider is what we call a home equity line of credit. Okay, great. What is that? It is a loan based on the equity amount in your existing primary home. So for example, let's say you've owned your home now for 20 years and you're free and clear. I know this doesn't apply to a lot of people at all, but if it does, then you can pull out, let's say your home is worth $400,000 and you want to have access to a credit line of about $200,000. Picture it like a giant credit card, but it's collateralized by the equity of your home. In either case, you would qualify similar to a conventional loan. Your credit scores have to be usually about 680 or higher. A lot of the big banks have actually pulled out of that market, but there's still some available to you, especially as a first lien. So again, your credit scores need to be about 680 or 700 better. And in terms of income requirements, yes, you will need to show you 2 years of history, much like your conventional loan does. But there is no down payment because all you're doing is accessing the value that you already have in your home. So that's one of the giant advantages of having a home line of credit. Now, the other giant advantage is once you do get qualified for it, and let's say you're qualified for $200,000 line of credit, is you have access to that immediately. So in other words, if you're trying to buy that $250,000 home that we had in the earlier example, you have to go through all the qualifying nature for the prior to conventional and the DSCR loans. That could take 30 days. But if you've already got your HELOC set up, you're literally just writing a check to buy that home. The ability to close quickly within a HELOC is tremendous. And that gives you distinct advantages because you can get a better negotiation to say, hey, I'll buy this house for $250,000. It's going to take me a month, or I'll buy it, which one is stronger? Well, I'll buy it for $230,000 and we'll close next week. Sellers like that, trust me. So the HELOC has its own distinct advantages. We'll get into an example combining all three, showing you the advantages and disadvantages right now. So let me quickly summarize all these three loans compared to each other. So we have the conventional, we have the DSCR, and of course we have the HELOC. And so the conventional loan, in terms of the credit scores, all of them are going to need at least a 660, probably 680 or better, but at least a 660 going forward. In terms of income purposes, on the conventional loan and the HELOC, you have to show 2 years of history. So the advantage of the DSCR loan, of course, is you do not have to show any income at all. As long as you can meet that DSCR ratio of 1 or higher, your rents to your expenses, the DSCR loan is the way to go. Okay. In terms of down payment, the lowest down payment is going to be shown on the conventional side at 15%. On the DSCR, it's going to be 20 to 25%. And the HELOC doesn't really have a down payment. You're just accessing, once again, what's already in your equity in terms of your home. So the advantages are you use the conventional loan if you can qualify for it because it can have the lowest rate. Use the DSCR loan if you're especially a self-employed, you just have a complicated tax return and you really want to just avoid all that mess, you go with the DSCR loan. If you've already got a free and clear property or lots of equity in your property, then HELOC may be the way to go. The advantage of the HELOC is the speed at which you can close. The conventional and the DSCR loan require about a month to try to work through the loan process. But again, already working through the HELOC process, and you already have that in place, then you can write a check right away and you can close within a week. And that gives you tremendous negotiation advantage. So I hope all that makes sense to you. I can walk you through all this, help you finance your deals. I'm the Mortgage Patriot, Kevin Fagan on your side. Make it a great one.